For most of the portfolio, and we talk about saving, investment, or even for retirement purpose, equity always is the major component of that portfolio. So now this time we need to turn into the equity portfolio management. First of all, why equity? What role that the equity in the overall portfolio? There's three major advantage that using equity. First, inflation hedge. Interesting, right? Inflation hedge. In a period of time, we have a high inflation. Right? According to the business cycle, they always have a period of time. Over a longer period of time, you have inflation pressure. Now, inflation meaning that the investment will lose the true fundamental value caused by the high price price increase on the general product, and that caused the loss, right? The opportunity loss from the equity value, the portfolio value. So to prevent that and invest in the equity side, like stocks, had this particular advantage because, right, all those company, right, has they can have this so-called preserved purchasing power during the period of inflation because they can actually increase their sales price, all right, to reflect the pressure of general increase of prices. So they're able to maintain the reasonable return. So, however, in a bond or fixed income security, they don't have this type ability to do it. Right? So the bond is actually a very poor inflation hedge. The second component of using equity is the growth potential. We all know that. So if you're looking for the realized return, the real return, right, for an investment, and equity actually is much better than a bond. The third had a diversification effect. Okay, because you have variety choices of equity, right? Then later on we'll talk about different style, different character. That means they have different kind of correlation involved. So we know that for diversification, you're looking for some asset they have less correlated. They're less correlated. So since they have a different type of equity, therefore provide us the benefit for diversification. Now next, in terms of the management, all right, we have a different type or different approach of management. Basically classified, we all know, basically have three types: the passive, all right, or the active. We all know that there's something between them. It's called the semi-active management. And today's most of the fund instead of there's also basically classified today, all right, in terms of the public fund, basically it's a passive versus the semi-active. Now the active fund based usually in the private equity type now today has less and less compared to the entire population of equity portfolio. Now passive in management, we all know that the purpose of that is to track index, or to track index such as the index fund or the index ETF. All right, so it is the mimicking portfolio. All right, so it's tracking that index. It's the mimicking portfolio with the ETF, exchange traded fund. All right, so they're able to actually replicate the index components and keep track the index. Now, since this is just the mimicking a portfolio of indexes, and the index is a well diversified portfolio, therefore, the management, all right, strategy is a beta seeking. All right, since you're not going to beat the market, you just have to keep track the market. So that is the beta. All right, so it's the beta seeking. And the bottom line here is that the reason you are looking for the passive because you believe that the market is efficient, right? So there's no way that you can arbitrage or take arbitrage profit using the inefficiency of the market because you think in general the market is efficient. On the other side, let's talk about active management. Active management view the market is inefficient. So we're going to take advantage of that. Therefore, the purpose of this management style is seeking for alpha. It's to seeking alpha, to seek alpha. So we call alpha seeking. The alpha seeking is pretty much we call arbitrage process. So in other words, try to take something from the market inefficiency, all right, basically using the long and short type of strategy, all right. So it's tried to really using that strategy to take the excess return, which is can outperform the index. Okay, outperform index. So basically, all right, passive management is beta seeking, relatively low cost, where the active management has alpha seeking, relatively high cost. So something between them, between the beta and alpha seeking, we got this called the hybrid or semi-active management. All right, semi-active management. It's an attempt to earn a higher return than the benchmark, but at the same time try to minimize risk, right? So that deviate from the benchmark. Okay, so here we talk about the risk, all right, not the total risk of return, it's risk of a deviation from the benchmark. We talk about this one in the next table here. So the semi-active manager is the goal is to minimize the risk of deviation from the benchmark. In other words, they try to minimize the tracking error. At the same time, it try to earn some higher return. All right, so it's to maximize the excess return, at the same time minimize the risk of deviation. So same thing again. If the semi-active managers also view that the market is sometimes inefficient. So in other words, in general, over a longer period of time, the market is efficient, but in a short period of time, it could be inefficient. So this is the differences here. Now here, let's talk about how do we classify different category, and then let's see different type of manager, what are their expected performance. All right, expected performance. Now we got the passive, all right, and this is a passive we call indexing strategy, and the active strategy. And between them we call enhanced index. Enhanced index, today we have a lot of fund we call smart beta fund. These are the enhanced index. It's still beta seeking, but better than that, better than the market itself, and they want to get some excess return. So this is called the enhanced index approach. To see the performance, all right, the performance of these different type of the management strategies and different type of fund, we use actually 2 factor and 1 index here. Now first, we look at that return and risk. But remember here, the return, we're not looking for the total return. We're looking for the return is the expected active return. This active return, keep in your mind, it is a different, the expected return of the differences between the portfolio return you have and the benchmark return. So you try to track the index, right? So you're looking for the deviation from that tracking index return. So that will see, like, it's called the tracking error. All right, tracking error. Now, of course, we don't say tracking error is bad because you have a high tracking error, but it got higher return, then it's a positive. So for the index approach, indexing, or this passive approach, we expect your return supposed to be 0 because your goal is to track the index. Now, if you have active return, active management, then we expect you will have a higher return because you search for alpha. So usually it's greater than 2%, around 3, 5, even 10, 20%. All right. So enhanced index approach, which is the semi-active approach, is between them, like smart beta fund. We expect you have a 1 to 2% in terms of the expected active return. Now, this active return is average, so it varies by time. So we want to see the variation of the volatility of your tracking or your excess return. So we call tracking risk or active risk. That is a standard deviation of this active return. This is called active return, and then we annualize that, right? So this is just like a volatility. So it's a volatility of the active return. We expect that for the indexing fund or indexing ETF should be less than 1%. For the active fund, of course, we allow them to have, of course, because it's real risky and vary, so we allow that volatility of active return greater than 4%. But we don't want to get too big, right? And then for the index fund, enhanced index fund, it's around 1 to 4%. But it's hard to measure that, right? The return and the risk. This reason we got this ratio here. All right, the ratio here is how about that's using the expected active return divided by the annualized the standard deviation of the active return, which is like the active return per unit of its volatility, per unit of its volatility. This is called the information ratio. Remember that. This is called information ratio. So next time people ask you, what is the information ratio? It's not a Sharpe ratio. Right? Information ratio is active return over the active volatility. Now, for index fund, of course, has to be 0. The indexing fund. For the active fund, around 50% or 0.5. For the enhanced index fund, we expect that information ratio is around 0.75. Therefore, that's the reason why the enhanced indexing is now so popular, because even though they are not going to chase in a high return, but the risk adjusted excess return, the risk adjusted active return, that is the highest. That's the reason why the enhanced index fund become very attractive.